What if affordability improves because certain cities take the hit for everyone else? That's the 2026 story AI is screaming about. The headlines say low 6% mortgages and a 1% price rise. The model says, not everywhere. We're diving into Cape Coral and Stockton, where insurance, maintenance, and pandemic-era leverage are the real sellers. No mass layoffs needed, just math, margins, and weather risk. Stay with me for the 3 signals that separate a reset market from a quiet crash, and the checklist to avoid buying the dip in a flood zone. You're told the fever broke, rates with a 6 in front, prices up a hair, sales ticking from coma to nap. So why is the AI dashboard lighting up certain zips like a check engine light on a 12-year-old BMW? Because national averages are the most polite lies in housing. Here's the glossy headline: low 6% mortgages, a 1% nudge in prices, and a little more movement in existing home sales. Now the other screen, coastal Florida and fringe California, where listings linger. Sellers toss out buy-downs like candy, and buyers still ghost showings when they see the insurance quote. No mass layoffs, just balance sheets getting sandblasted by costs that don't show up in the mortgage rate. Think seesaw. If affordability improves on the national chart, someone's getting lifted only because someone else is getting crushed. Florida sits on the heavy end. Parts of NorCal sit on the heavy end. The Midwest gets to float for once. Forecasts back it up. Fewer metros are expected to fall next year, but the ones that do, deeper drops. Cape Coral shows up near the top. Stockton's not far behind. That's not panic. That's math colliding with risk pricing. The soft landing analogy everyone loves? It's a smooth flight for most of the cabin, while a few rows are getting sprayed by a busted window seal. Same plane, very different experience. You don't feel it unless you're in those seats, or you try to insure a roof in a storm track. Silent drivers are doing loud damage. Insurance spikes that double faster than paychecks. HOA boards fattening reserves after one bad season. Maintenance going from "we'll get to it" to special assessment due next month. Pandemic buyers sitting on thin equity with extra lines of credit and surprise surcharges. None of that makes the jobs report, but it makes a seller. We're going to strip this down to 3 signals so you can separate a gentle reset from a quiet crash without leaving your couch. First one lands now: insurance inflation outrunning wage growth in specific counties. When the premium plus HOA reserve jumps faster than your paycheck for 2 straight seasons, you create forced sellers without a layoff. Let that sink in. If that's the national mirage, let's walk into ground zero. 2 cities where the math still doesn't pencil even with a good rate, and the discount comes with a monthly bill you can't negotiate. What do a hurricane belt city and an inland California metro have in common? They're both flashing red, but for totally different math. Cape Coral on the Gulf, Stockton in the Central Valley. Opposite climates, same outcome the model points to. 2026 price cuts that can scrape into double digits for Cape Coral and still sting in Stockton. Different storms, same pain. Let's set the board. Cape Coral rode a migration wave and is now choking on the bill. Stockton rode pandemic appreciation and is dealing with the hangover. Neither market needs a layoff cycle to wobble. Sellers are motivated because owning is getting more expensive by the quarter, and buyers can do arithmetic. Cape Coral first. Wind and flood premiums are blowing past sanity. Insurers left. Risk-based pricing stepped in. Some owners now pay more for coverage than for a used car payment, and that's before the HOA bumps reserves after rebuild season. The carrying cost turns a starter home into a subscription you can't cancel. When the quote hits the inbox, the listing hits the market. Stockton's not a beachfront story, but it's still weather adjacent. Insurance creep tied to wildfire exposure isn't loud like a hurricane. It just ratchets. Newer purchases face reassessments that nudge property taxes higher. Utilities and water keep rising. Older housing stock needs roofs, plumbing, and panels. And the repair guy doesn't care that you locked 2.75% in 2021. Thin equity from pandemic buys makes the calculus tight. Forecasts call out both regions for localized declines, while the national chart smiles. Florida metros, Cape Coral included, take deeper cuts. NorCal fringe markets like Stockton absorb softer but very real drops. The renters to buyers pipeline thins when ownership costs spike. If the monthly nut explodes, the funnel shrinks. On the ground, the market feels sticky. Listings sit, price cuts stack, sellers throw in rate buydowns, and buyers still balk when the insurance or HOA number shows up. Concessions don't cure recurring bills. That's the quiet crash texture: slow, awkward, relentless. You want signals you can spot from your couch? You'll get 3. Here's the second one right now. The inventory pipeline flips from tight to sticky. Days on market rise. More listings show multiple reductions. Absorption stalls even as new listings hold or climb. It's the housing version of a store, with full shelves and fewer shoppers. You've seen the where and the why. Now let's build the checklist so you can go on offense without becoming the discount's next victim. If a crash doesn't kick off with layoffs, how do you spot it before the comps catch up? You use a screen that ignores the cheerleading and looks at bills, timing, and who's trapped. I run the same 3 checks on any metro, and it flags the markets where reset is just branding for a slow-motion markdown. Here's the simple, repeatable screen. First signal: the insurance-to-income ratio spikes. Not just one bad renewal, 2 straight seasons where annual premiums plus HOA reserve bumps outrun local wages. In Florida, that surge started when carriers pulled back and risk-based pricing moved in. The effect is sneaky. A house that penciled last year now clears your bank account, like a streaming service you forgot to cancel, except it's a 4-figure charge. When that ratio climbs, owners don't need a pink slip to become sellers. They need relief. Second signal: the price cut ladder shows up. Watch the share of listings with 2 or more reductions, while days on market grinds higher. If new listings are steady or rising at the same time, that's not seasonality. That's demand flinching at the true cost of ownership. In markets flagged for 2026 hits, Cape Coral on the deep side, Stockton on the softer side, you'll see the ladder build before the headline indices budge. Agents can bribe with rate buydowns all day. The ladder still climbs when carrying costs won't. Third signal: negative carry traps. Pandemic buyers with thin equity and a HELOC reset. Special assessments for roofs, concrete, or code fixes. Insurance surcharges baked into renewal math. Equity on paper doesn't pay surprise bills. Owners who can't refi out of it start listing, then cutting. It's real. It's happening. Tie it to the rate backdrop. Even if mortgages float in the low 6% band in 2026, that doesn't neutralize non-mortgage costs in high-risk metros. Wage growth is not matching insurance, HOA, taxes, and utilities in these pockets. That divergence is the engine of local pain, while national charts look fine. So, your survival checklist. Demand a 5-year total cost model, principal and interest, insurance with projected increases, taxes, HOA dues and reserves, maintenance, and any assessments. Pull flood and fire maps. Ask which insurers will write the policy and at what deductible. If a seller won't share recent premium quotes, walk. Shop when the odds tilt your way. Post-storm rehab season, sellers holding assessment letters, or stale listings past 60 days with 2 cuts and soft showings.